It is actually quite funny to watch everyone lose their minds over a few red candles, while I sit here on my lounge chair barely moving a single muscle in my body. The world is completely obsessed with the idea that every minor downward movement in the market is a once-in-a-lifetime opportunity to buy the dip. The reality is much simpler and much more boring than any of the fear-filled headlines or sensational news articles would ever suggest to the average person. Complexity is a status signal for people who want to feel smart but stay poor, and most of you are making this investing game way harder than it ever needs to be. I am looking at a semi-red day in the market, and I see a lot of AI names and semiconductor names falling, and people are acting like it is a tragedy. Financials were red as well, probably because the inflation numbers came in hotter than expected, and the market is throwing a tantrum because it realizes rate cuts might not happen tomorrow. Hotter than expected numbers impact names like SoFi and Robinhood and the rest of the fintech space, but I am not going to talk about that as a crisis, because to me these are obvious names for long-term investors. If you do not want to catch a falling knife, that is fine, and we can keep that story for another day, but let us focus on why this is not a dip worth buying yet. We have been going up and up and up for weeks and weeks in the semiconductor sector, and names have doubled, or more than doubled, since the end of March. If a stock doubles in a month and a half and then drops 4% on a Tuesday, you are not looking at a bargain, you are looking at a rounding error and a massive overextension. Some names are down close to 10%, and Qualcomm was down 12%, but this is still not a buy-the-dip situation because the baseline is still insanely high. Micron on paper looks very cheap, and that is fine. But you have to understand that a company can be fundamentally undervalued while being technically overextended. You do not want to chase names at all. Time highs that have gone up 50% over the past couple of days, because that is how you become exit liquidity for people like me. As you know from my portfolio overview, I am taking profits, and that is exactly what I did on Monday because I like having cash more than I like having stress. I sold portions of Google and Rocket Lab and Micron and AMD because the vertical line on the chart was starting to look like a mountain that I did not want to climb down. I did not take profits on Nebus because they report soon, but I did sell covered calls, which means I am getting paid to wait while everyone else is biting their nails. If the stock stays under $220 by Friday, I keep my shares, and I collect the premium, which is the ultimate lazy way to make money. Looking at the market heat map, you still see some green with Nvidia and Apple, but the rest of the board is a sea of red with Broadcom and Intel and Qualcomm leading the slide. In the grand scheme of things, this is nothing, and it is not even a breather. It is just a quarter of a breather for stocks that are up hundreds of percent. Shutterstock Tenswa Micron is up God knows how many thousands of percent over the past year. So one red day is not a trend, and it is not a signal to dump your life savings into the sector. CoreWeave is down 6% and White Fiber is down 3%. But again, look at where these prices were just last Thursday or Friday morning. Nothing has really changed fundamentally, and the market is just taking a tiny step back after a marathon sprint that was frankly unsustainable. Fintech names like Robinhood are still down close to 50% year-to-date, and the market is punishing emerging markets like Latin America before they even report earnings. Sea Limited reported a good report, and the stock went up, but it is still down 50% since September, which shows you how long the recovery road can be. Mercado Libre is an excellent company with growth at 49% year-over-year. Yet the stock is struggling because it is not a flashy AI name. Right now, all of the money is flowing towards semiconductors, and it is being sucked out of software names and high-quality fintech businesses. Even Palantir, which continues to accelerate revenue growth and expand margins, is getting punished because it does not fit the flavor of the week for Wall Street. High-quality companies like Shopify are now under $100, and if it drops to the low 80s, I might actually bother to open a position. I am adding Lemonade and Axon to my watch list, because things are getting interesting at these prices, while the rest of the world is chasing the shiny objects. I sold shares of Rocket Lab and AMD and Google and Micron for a profit because timing was great, and the cash position makes me more comfortable. Shutterstock, my cash position is back above 6%, which gives me the luxury of reacting if a real dip actually happens rather than just a tiny wobble. If Google goes back under $350, I will have the cash to accumulate more shares, but I am not going to lose sleep if it does not happen. The whole point of taking profit while staying exposed is that you benefit if the stock goes up, but you have the dry powder to act if valuation finally catches up. I appreciate all the birthday wishes from yesterday, and if you are new here, you should subscribe, because it is free and I am too lazy to sell you a course. The year-to-date performance of your portfolio does not matter in the slightest as long as your long-term strategy is built on great companies at cheap prices. Nobody is going to give you a gold star for being up 10% in May if you are down 50% by December because you chased the momentum. Non-institutional investors like us should look at the quality of the companies and whether their earnings are actually accelerating rather than looking at daily candles. The narrative last year was that Google was a bad company, and you could buy it at $150 for a long time while the experts laughed. Those who accumulated shares are quite happy now that the stock is double that price because they were patient enough to wait for the momentum to return. SoFi and Robinhood are better companies today than they were a year ago, yet the market hates them because macro factors like inflation stay high. If interest rates stay higher for longer, then these names get hit, but you should not be investing for next month or next quarter if you want to be free. You are investing for many years, and today's market has many names that are down a lot and not participating in this specific bull market rally. At one point, the music will stop for the AI names and the market will start looking for value in the sectors where nothing has been priced in yet. You want to be in a position where you built your stakes at undervalued prices so you can just sit back on your couch and watch the ride up. Mercado Libre is an $80 billion company with incredible growth, but the market is worried about margins and credit portfolios in Latin America. If you do not have the time frame of a goldfish and you buy for the next decade, you see a multi-bagger in the making rather than a daily headache. Sea Limited is another example of a company that had flat revenue for a while, but is now seeing acceleration with 46% year-over-year growth. This is what you want to see, which is top-line growth in a company that is already big enough to dominate its region while the market looks elsewhere. Then there is the company that gets zero love despite growing its EPS by 100% and its revenue by 41% year-over-year. Bad companies do not grow like that, and they do not see accelerated growth in a high-interest rate environment while maintaining solid guidance. I view the guidance from companies like SoFi as a positive thing because it assumes the worst-case scenario for the economy and still shows profitability. Meta is another one that people love to hate despite it being a $1.5 trillion company that grows revenue at 33%. The market tells you it is a bad company because they are spending money on data centers, but the return on invested capital is still world-class. Even Amazon and Nvidia had long periods where they did absolutely nothing and stayed flat for 7 months while investors got bored and sold. Investors who study the business instead of just looking at stock prices have a massive advantage because they see the disconnect between reality and price. You cannot tell me we are in a buy-the-dip environment when some names have doubled in the past 30 days, and that is simply not normal behavior. Shutterstock, you buy the dip when people are truly fearful and saying that the stock will go to zero and that you should have sold at the top long ago. That happened in March when everyone was laughing at our portfolios. And that was the exact moment when we were accumulating shares of great businesses. Right now, I still think a lot of people are quite greedy, and the music might go on for a while, but it will be violent for those who FOMO'd in late. You do not want to be a Gucci begolder who bought the top because you were afraid of missing out on a trend that everyone was already talking about. I am going to keep my cash ready and keep my strategy simple, because complexity is just a way to hide the fact that you do not know what you are doing. If Shopify drops to the low 80s, I will be there. But if it stays expensive, I will simply find something else that is boring and ignored by the masses. The goal is to build a portfolio that allows you to live life on your terms without having to check the market every 5 minutes to see if you are still rich. Real freedom comes from the discipline of sticking to a plan that is so boring that most people would rather gamble just to feel some excitement. I prefer the excitement of having a high net worth and the freedom to spend my days however I choose without answering to a boss or a clock. We are seeing a big disconnect in the market, and that disconnect is where the real money is made for those who have the stomach to wait it out. Thank you for watching and for being part of this community where we value logic over hype and patience over frantic trading. I will see you all in the next video after I have had another coffee and watched another sunset, while my assets do all the heavy lifting for me. The invisible system of rotation is always moving, and you just need to be positioned in the right place before the capital starts flowing your way. Stay clear and stay focused. And remember that the best investment you can make is often the one you decide not to make when everyone else is shouting. The sun is setting on the old way of doing things, and the new era belongs to those who can remain calm in the middle of a digital storm. Wealth is a quiet game, and I am perfectly happy playing it in silence while the rest of the world screams at their screens for more dopamine. Take care of your capital and protect your peace of mind, because those are the only two things that actually matter in the long run of this game. I am signing off now to enjoy the rest of my evening, and I hope you do the same instead of worrying about a 4% drop in a semiconductor stock. Life is too short to be stressed about numbers that change every second, so focus on the things that are permanent and the things that bring you joy. The live session in France will be the moment where we pull back the curtain on all of this, and I look forward to seeing the serious investors there. Until next time, stay lazy and stay wealthy, because that is the only way to truly win in a world that is designed to keep you busy and broke. believe in your process and trust your research, and never let a red day dictate your self-worth or your long-term financial destiny in this market. The pilot has signaled that we are beginning our descent, and I am ready to move on to the next chapter of this journey with all of you. The math is on our side, and the time is our friend, so there is absolutely no reason to rush into a burning building just because someone said there is gold inside. Wait for the fire to go out and then walk in and pick up the pieces for pennies on the dollar, while the heroes are still in the hospital. That is how you win, and that is how you stay free, and that is how you build a legacy that lasts longer than a single market cycle or a trend. Everything is a pattern, and once you see the pattern, you can never unsee it, so keep your eyes open and your mind clear of the clutter and the noise. I will catch you in the next one, and we will continue to break down the reality of wealth and the beauty of extreme discipline in a chaotic world. Goodbye for now, and may your portfolio be as boring and as profitable as a well-managed utility company in a growing city. The end of the day is just the beginning of the next opportunity to do absolutely nothing and let the power of compounding take over your life. Stay clear and stay wealthy, and I will see you soon from the other side of the world where the logic is the same but the view is different. There is power in silence and there is wealth in waiting, and I hope you find both on your journey toward total financial independence and peace. The market will always be there tomorrow and the next day, so do not feel the need to solve every puzzle in a single afternoon of trading. Take the long view and the high road and the easy path, because the hard path is crowded with people who are failing and crying for help. I choose the easy path, and I hope you join me, because there is plenty of room for everyone who is willing to be patient and disciplined. One last sip of coffee and one last look at the charts before I close the laptop and enjoy the silence of a successful day of doing nothing. The work is done and the capital is deployed, and the rest is just noise that does not deserve your attention or your energy today or ever. Keep your head up and your costs low and your expectations high for the long term, while remaining completely indifferent to the short-term noise. See you in the next one and stay wealthy.